Hello, and thank you for joining today's webinar on paying for caregiving. My name is Jenny Werwa, and I'm the Director of Public Relations for the National Reverse Mortgage Lenders Association. As we all know, home care services can make a tremendous difference in the quality of life of older adults who are aging in place. We hear from our members that when they are meeting with seniors and their families, the conversation often turns to long-term care supports and a discussion of the options to pay for help in the home. Next slide. Today's presentation, which is part of our third annual Reverse Mortgage Education Week, is for homeowners and their loved ones like you who are aging in your own homes. By sharing information about payment options with you, we hope to make it easier for you to consider the strategies going forward for how to pay for the care that you need. Thank you, and now I'm happy to introduce our three speakers. Next slide. Laura Ginta is the Director of Client Care for AMR Care Group. She is a certified senior advisor and Alzheimer's dementia specialist. She is a trained virtual dementia tour facilitator, Parkinson's professional, and AFA certified memory screener. Laura spent the past 9 years as the Director of Community Outreach for a well-known companion care agency. She was eager to connect with the community she passionately serves in a more meaningful way. She has recently joined AMR Care Group and is excited to be a part of that team. As a caregiver herself, Laura is very passionate about helping families succeed on their caregiving journey. Currently, she serves as the president of the Long Island chapter of the National Aging in Place Council and co-chair of Senior Umbrella Network of NASA and president of Gerontology Professionals of New York and vice president of AGES, the Association of Generation Experts for Seniors. Kelly Vasquez is the Chief Operating Officer and Chief Population Health Officer at Square Care, LLC. Square Care operates a management service organization providing services to a single TIN provider group as well as an IPA. Kelly oversees the operations of the MSO, which include managed care strategy and contracting, quality reporting and initiatives, and population health management. Additionally, Kelly oversees the network development and provider relations department, as well as project manages a single EMR RCM platform implementation across the network. Kelly holds a master's degree in social work from Fordham and is a licensed clinical social worker. Kelly is a SIFI certified and is currently enrolled at St. Joseph College, pursuing a master's degree in business administration with a concentration in healthcare management. And Patty Wells is a certified reverse mortgage professional with Open Mortgage and a member of NRMLA's board of directors and our education committee. Patty is dedicated to providing seniors, their families, and financial professionals with information and access to the reverse mortgage program. Patty entered the reverse mortgage field near the inception of the HECM program and has over 20 years of exclusive reverse mortgage experience. She's been a branch and regional manager of top 10 reverse mortgage companies, as well as a founder, co-owner, and president of a regional broker company. Over the years, she has assisted in training counselors as part of HUD's mandated training program, organized, conducted, and participated in countless seminars and meetings with members of Congress, AARP, and HUD officials, as well as community leaders in an effort to spread the word about the benefits of the reverse mortgage program. And now, I will hand the presentation over to Laura, who's our first presenter and moderator. Thank you all.
Good afternoon. I'm Laura Ginta, Director of Client Care with AMR Care Group and President of Long Island National Aging in Place Council. I'm happy to be speaking with you today and talking to you a little bit about payments and how we pay for care and what struggles caregivers face today. Next slide, please. Caregivers face many decisions in today's environment, and becoming a family caregiver is something that no one aspires to be when they grow up. There's no planning, no education to prepare for the emotional, financial, and physical challenges that accompany caring for another adult or someone with special needs. If you rewind the clock 3 to 4 decades, we were looking at a different landscape then. Primarily, family members were taken care of at home by other family members. This changed drastically, with single-income families being the exception and not the rule in today's environment. Families are hiring professionals to provide care or looking into assisted living or nursing facilities at a much earlier stage than they have ever before. The multitude of questions they face can lead them down an often confusing and typically challenging path. Next slide, please. Comparing the care options that are available always begins with finding out what level of care is needed. And sometimes that can be done by a professional assessment. Sometimes it's the family coming together to determine those decisions. Companion care is one level of care, licensed home care, certified home health care, which is covered by Medicare and only for a short period of time, hospice care, nursing care. Are modifications needed? So determining that care requires the assessment and evaluation for physical and support needs. Assessing if the care situation will be more physical, leaning toward the need for licensed home care or certified home health, hospice or nursing, or toward the more social or homemaker type things like transportation or meal planning that would lead more toward companion level care. Skilled needs, which would require nursing and finding out what, if any, modifications, durable medical equipment are needed, and determining the cost of those things and how they will affect the family as a whole. Next slide. A certified home health agency, which is sometimes known as a CHA, or heard as a CHA, which is the acronym, is covered by Medicare for limited assistance for a short term while a patient is rehabilitating. Many seniors today and their families think before they get to that place that Medicare will cover it and it'll take care of those costs and they don't need to worry. And they come to a rude awakening at some point when they realize that when their loved one is coming out of a hospital or rehab facility and needing assistance such as bathing and dressing and toileting, those things are not covered by Medicare unless the exception of having a patient who is going to need physical therapy, wound care, or skilled nursing services in the home can offset the need for some home care at an intermittent time while the client is getting better. Once there's no improvement, that coverage stops, and there is a time frame that will stop it as well. Next slide. Companion care is really the first level when someone is doing okay, but needing support and guidance. So someone with no physical needs, but having Alzheimer's and dementia issues, forgetfulness, wandering, the risk that they may leave on the stove or forget to shut off another appliance, those things are concerns that might offset companion care. Also, isolation and loneliness. The family's just not there as often as they were, and you're seeing depression and changes and someone not getting out of bed as often. So companion care can give transportation, socialization, mental stimulation, Alzheimer's and dementia behavior care, cooking, meal planning and preparation, hygiene monitoring and encouragement, balance assistance, safety monitoring, light housekeeping, laundry, linen changes, plant and pet care. And it's not limited to those things, but sitting down and having a full care plan to see what someone may have been interested in the past and find ways to stimulate them today that might have to be modified by any physical changes. That would be companion care. Next slide, please. Once someone is unable to take care of their activities of daily living, dressing, toileting, bathing, feeding, and transferring, those types of needs would require a licensed home health aide, an HHA, which would be a home health aide, or a certified nurse's assistant, CNA, would be required to help clients physically dress, toileting and changing, transferring. So a big way to tell if someone needs a companion or a licensed home health aide would be if they can self-propel out of a chair or out of bed without anything more than maybe a balance assistance. If they need to be lifted or any weight bearing, that would need a licensed home health aide. Needing to be fed, physically bathed, but a licensed home health care worker will also do light housekeeping, plant and pet care, medication reminders, shaving, hygiene, and skin care, as well as some stimulation. Next slide, please. The costs that are associated with home care can be exorbitant at best. The average cost of a home health aide or companion on a national level is $19 per hour. New York State, we see rates as high as $30 per hour. And I've seen higher in some areas depending on the care that's needed. For clients who require 24-hour care, this can run in excess of $13,000 per month, which is akin to and sometimes less than some of the costs of assisted living. This fact sometimes forces a move to an assisted living community or facility, even when staying at home might have been the first choice for the family. Next slide, please. There are very limited payment options for home care, either private pay, long-term care insurance, a pool of money that someone would purchase ahead of time in order to pay for care, and they would have begun paying for that in their younger years when they were healthier, and sometimes as late as in mid-70s to start that long-term care policy, and then continuously paying for that until they need it, and that would be a private insurance. Veterans Aid and Attendance Program is a New York-based program. There are similar programs in other states, but depending on where your state is, you would need to reach out to your Veterans Administration to find out if they have a similar program. And it would provide certain amount of monies for a couple, certain amount for a single, if they qualify by income and asset guidelines, as well as having the ability to need care in the home and be considered homebound. There's respite grants by organizations on a national level, such as the Alzheimer's Association. There may be other grants in your area. You'll need to check and look up respite grants, which would give a certain amount of money to caregivers who are living with an afflicted person with Alzheimer's or dementia or certain other diagnoses. Reverse mortgage is one important way that seniors may be able to stay at home, and it's an often overlooked option. Home equity loans is another. Sale of personal property, liquidating assets, stocks, bonds, etc. Another way that home care is paid for quite often is family financial support. The idea that mom and dad took care of you, now it's your time to take care of them. Medicaid would be another New York community-based program. Other states have similar programs. You would have to, again, reach out to the Office for the Aging in your state. Next slide, please. Aging in place can often require home modifications or equipment to maintain someone living safely at home. Some home modifications may range on average anywhere from $500 to install a grab bar and do minor modifications to upwards of $50,000 to $100,000 in major construction costs to make kitchens and bathrooms handicap accessible, widening doorways, installing ramps, stair lifts, possible furniture modifications such as low-profile box springs and lift chairs. All of these things have to be taken into consideration for the cost of aging in place. Next slide, please. This is a case study of Mrs. Gold. Mrs. Gold lives at home and requires assistance getting in and out of the shower. More of a balance assistance, she also has difficulty standing for long periods of time. Mrs. Gold would benefit from a companion visiting 4 hours a day, 5 days a week. She needs someone to prepare her meals, help with her household chores. She has poor eyesight, which makes it unsafe for her to drive. She's able to sleep well and is alert and oriented. It is unclear if she qualifies for government assistance. The cost associated with the care that she needs in New York State, or on average, would be $380 per week approximately, translating to $1,650 per month and $19,800 per year. And that's on a national level. Next slide, please. Mrs. Gold has a Social Security income of $1,550 per month, a pension of $300 per month, totaling a monthly income of $1,850 per month. She doesn't have long-term care insurance. Neither she or her deceased husband were veterans. She has upkeep of her home. She has to pay her taxes, utility bills. Paying for home care is a hardship, and she needs to think about her payment options and weigh the pros and cons of each of them. Her payment options in her situation is private pay, reverse mortgage or home equity loan, sale of personal property, liquidating her assets, family or financial support. If in New York State, possibly Medicaid. Next slide, please. Kelly Vasquez, who's the COO and Chief Population Health Officer of Square Care MSO, will talk to us a little bit about how the Medicaid program and Medicare programs may help to offset these costs and what options are available to pay for care and the eligibility rules. How you doing, Kelly?
Hi, Laura. Thank you so much. Next slide, please. Okay, I wanted to start by, I think, grounding us to a common misconception with the term and the use of Medicaid. Medicaid tends to have a negative connotation. People often feel that it is equivalent to welfare, poverty, people who may not work. But in actuality, Medicaid is an insurance. Medicaid is paid for 50% by the federal government and 50% by the state governments, and then operated at the county level. For this reason, you are going to see differences amongst the states in how they operate their Medicaid programs. For the purpose of today's presentation, I am talking about New York State Medicaid, but I certainly encourage you to look at your local area agency on aging to understand the Medicaid guidelines in your state. So for New York State, we are looking at health insurance for people whose healthcare needs exceed the amount of income they have and therefore are considered low income. So if your care is going to cost more than you're able to pay out of pocket, you could be eligible for Medicaid. We have quite a number of people on Medicaid in New York State, over 6 million, just to give you a sense of that. And with the passing of the Affordable Care Act, there were many states who decided to expand their Medicaid guidelines. So while some people were frequently not able to become Medicaid eligible, after the expansion, they were able to be. At this point, New York looks at 137% above federal poverty limits to allow you to become eligible for Medicaid. So this really opens up the area for people who would like to age at home and who have needs such as those that Laura described for Mrs. Gold to utilize Medicaid as a form of payment. Next slide, please. So here on this slide, I'm demonstrating some of the eligibility requirements by both income and assets. So Medicaid is looking to understand how much money is coming in each month. Typically, it would be your Social Security payments and or a pension, as well as how much money you have in the bank. When we think about aging in place at home, we have to consider the fact that you may own a home, you may own a car. You are entitled to own these things in community Medicaid programs. Again, in New York, there is an expanded community Medicaid program May not be the case in all states, but we will discuss the New York Community Program to give you a sense of how to become eligible. While simply looking at this slide, you may think, I would not meet this criteria. This is much lower than the income I receive. And so we're going to use Mrs. Gold as an example, who is bringing in $1,850 a month and seems to be over the Medicaid guidelines based purely on her income. I'll talk you through how we can handle that scenario. Next slide, please. So the first thing you would need to do is actually apply for Medicaid. For persons who are age 65 or older, blind, or considered disabled, you actually would apply via a paper form that you would bring with you to your local Department of Social Services. There's typically a local department near your home. You can check on various websites, whether it's the Department of Social Service website or the local area of aging. And I advise that you bring your application with you to that location to drop it off so that you have an opportunity to meet with a caseworker and have some of your questions answered. There is an allowance to actually mail the application, but in my experience, it tends to get lost, and I would not advise mailing the application. Next slide, please. One of the other common reasons why people don't apply for Medicaid, besides that stigma we discussed earlier, is because they believe that the applications are very daunting and ask for too much information. So I wanted to just kind of orient you to the information that's actually being asked for. So they're looking at your demographics, any persons living in your home, your current income, the amount that you pay in housing expenses. So what is your mortgage payment? What are your taxes? What is your rent? Those types of things. They also specifically look at how much you pay in water expenses per month, so you'll include that. And then they want to understand what type of insurance you have that you might already be paying for. So in many instances, people have Medicare that you do pay a monthly premium for, and sometimes people have a supplement plan, such as an AARP, that they're also paying for. So we want to include those payments as well. They also ask for any unpaid medical bills. If you've received a lot of bills for copays, deductibles, prescriptions that you've been unable to pay for, if you're approved for Medicaid, they will go back and pay 3 months worth of your unpaid bills. So you would certainly want to include that in the application. And then there's an additional form called the Supplement A, which I'll talk about in just a moment. If you look at the right column, these are the items of proof that you would submit along with your application. So you want to prove that you live in the state that you're applying. You want to prove your date of birth and your citizenship. So you can sometimes do that all on one item, such as a passport. You want to prove your income. So you would just show an example, a statement of your Social Security, or perhaps a transaction into your bank account to show your income. You'll give copies of your health insurance cards, proof of your housing expenses, and copies of those unpaid bills. And that's it. That's the only information you're supplying. So again, common misconception that you need to show all of your checking and savings account statements, that you might need to show deeds to your house. Those are all not required for community level Medicaid. Next slide, please. So as we discussed the case of Mrs. Gold, and what is very common for many people who are attempting to age at home, is that you will need to engage in a long-term care plan. What that means is that you're going to access care in your home that will allow you to have things like transportation, preparation of meals, assistance with your activities of daily living, doing some chores, helping in and out of the shower. All the things that Laura described earlier are frequent needs. And so one of the ways that you can get all of those services is through a managed long-term care program. Once you have Medicaid eligibility, you can actually apply for these programs. There is another program in New York, and maybe in other states as well, called Medicaid waiver programs, where these same services are available without actually having to register for a managed program. Some people don't like the concept of a management through an insurance-based program, and so they'd prefer a waiver. The thing about waiver programs is that they do start to phase out sometimes, and you wouldn't want to get enrolled and then the waiver is finished and you no longer have services. So it is an option, and you may want to explore that, but for purposes, again, of this example, we're going to use the managed long-term care route. So if you felt that you required those level of services that we've described and you wanted to apply for managed long-term care, one other piece of information you would want to put in your Medicaid application is the Supplement A form. Next slide, please. This is an example of the Supplement A form. The purpose of this form is to try to understand how your health has impacted your ability to perform your normal activities. So in here, they're actually attempting to establish a form of disability. And this disability is different from someone who might have gone out on work disability or been injured at some point in life. This is a disability associated with things like diabetes. As a result of diabetes, you may have difficulty with eyesight. You may have difficulty walking. You may have specific meal plans you need to follow that require assistance. So these are the types of things you would include in your Supplement A in order to become eligible for managed long-term care in your home. Next slide. So what happens next? You've filled out your Medicaid application and you've dropped this packet off at your local Department of Social Services. Once the packet is reviewed, which typically takes about 3 months, but if you have all of your documents and all of your proofs buttoned up nicely, it can be done in as quickly as 1 month, you will receive a letter in the mail. That letter will most likely say to you that you have been approved for Medicaid, but that you have an excess income. So we're going to think about Mrs. Gold, who has an income of $1,850, and we know that the Medicaid guidelines in New York State are $842. So clearly she is over that guideline. What they are saying to her is, if you can find a way to get rid of that excess income, we will give you Medicaid. Okay, so for purposes of this illustration, the excess income is $1,008 that we need to, quote, get rid of in order to get Medicaid. Next slide. So excess income is also known as a surplus, is also known as a spend down. Essentially, Medicaid is trying to get you down to the level of Medicaid eligibility, but is recognizing the fact that you do have healthcare needs that are making you eligible for this insurance. So they'd like to offer you Medicaid insurance, but they need you to handle your spend down. Next slide. So there's 3 ways that you can do this. The first is you can act as if your Medicaid is like any other insurance and you can pay for it. Just as you'd pay a monthly premium for your Medicare, you would submit that $1,008 to Medicaid on a monthly basis and you would have Medicaid. The reason some people choose to do this is because the cost of their care is much more than $1,000 a month, so they're actually getting more of a benefit from Medicaid than they would if they kept that money. Typically, this is unlikely. We need money to spend on other bills, and we need to be able to enjoy life, so we don't want to give all of our money away. So another option is to spend that money on your health care and submit proof of receipt to Medicaid. Once they get that receipt to show that you're indeed spending money on your health care, they will actually turn on your Medicaid. The problem with this option is that many times, by the time you've spent all that money, it's the end of the month and you've never had the access to your Medicaid benefit. So I don't usually recommend that option either. So the option that I'd like to recommend is to use a pooled income trust. This can only be used if you're considered disabled, which is why I had you fill out that Supplement A form ahead of time. So if we get ahead of the game here, we can move through this process pretty quickly. Next slide. So a pooled income trust is actually a national program, but based on the Medicaid rules in your state, there may be some differences in how you can access it. Essentially, this is a shared account where people's money go into each month. And in the event that that person passes away, the leftover money in this account is given out to the charity that runs the pooled income trust. So in other words, if you're putting money in this monthly, there is not a way in which you could share that money back with your family members after your passing. However, the only amount of money you're going to put in here is that monthly spend down, so that $1,008. Each month, you're going to put it in this account, and that is going to protect it from Medicaid. So Medicaid now believes that you have an income of $842, and you now have benefits, and you can use all of the home care services that we discussed. What you do with the money in this account is you submit your monthly bills to this account, and they pay it from there. So your money is not lost. It's actually your money. You could submit your water bill, your rent bill, your taxes, your credit card bills, any of the bills that come in that you would normally have spent that money on, you send it to this account and they pay for it. The one thing it is not is it's not cash. So you don't have cash in your pocket anymore, but rather your bills are being paid from a third-party account. There are some monthly and annual service charges to be mindful of, And there are varying different trusts that you can look at based on the amount of money you have to put in. I do have a link to that on the bottom of this slide that you would be able to look at and get an idea of the different pooled income trusts. Next slide. And so once you've, quote, handled your spend down and put your money in a pooled income trust, you would go back to that managed long-term care company, you would complete an application, and you would be able to start receiving your managed long-term care services. And those services, again, are going to be the home health care, the transportation, the things that you may need to actively age at home safely. And again, I've included a link to show you some of the New York State managed long-term care programs that are available. Next slide. And so to summarize what we've done for Mrs. Gold, we've been able to get her eligible for Medicaid. We did apply for a pooled income trust so that she can put that excess money into that trust each month. And in doing so, we were able to apply for a managed long-term care program. That program is offering her 12 hours of home health aid service. It also offers equipment such as a hospital bed, commode, walker, wheelchair, some of the assistive devices that might be necessary to get around safely. It will provide ambulette services to and from doctor's appointments. There are supports involved, so you'll have care management services where there are social workers and nurses available to offer support. And then there are services that can be offered in the home, such as speech, physical therapy, occupational therapy, as well as home visiting physicians if that's necessary and Mrs. Gold has trouble leaving the house. And that's all for my summary. Laura, I'll pass it back to you.
Thank you, Kelly. That was really a lot of great information. I did have one question for you that maybe others might have thought as well. I didn't hear anything about companion care. Will Medicaid pay for companion level care?
Yes, so as a part of the managed long-term care program, when you're enrolled in that, there is an assessment done. And that assessment will take into account the various companion level needs that you might have that are in addition to some of the skilled needs you might have. So it's really a combination. When we think about some of the things on the companion list, such as transportation, such as someone who can help cook meals for you, who might be looking at some light housekeeping, all of that would be covered under your managed long-term care plan.
So they would be able to take someone who's covered under Medicaid out of the home in their car, a Medicaid caregiver? Medicaid
so that is one
funded
thing,
caregiver?
Right. So that's one thing that is challenging. Various laws and really insurance does not want these home health aides to be driving the people in their cars. I have seen agencies that do it, but many don't. So rather, you do get transportation services through Medicaid via ambulettes. And so if you needed to go to a doctor's appointment, you could use that. Another option I've seen a lot of persons do when they're living at home is the able rides and accessorides, which are paratransit, and their home health aides can come on the buses with them to accompany them to food shopping or things like that.
That's always helpful. So just to be clear, they would need some type of physical activity of daily living type assistance for the Medicaid program. But if they have that, they can also help with the support companion type services. Is that correct?
That is absolutely correct, yes. So in the assessment for the managed long-term care plan, there will be a skilled level of services needed. And in addition, they can access all of those other services. That's correct.
Okay. And the managed long-term care program as opposed to the consumer-directed program under Medicaid. Can you explain the difference of those?
Absolutely. So the consumer-directed program is something called CDPAP. That's the acronym for it. And that allows individuals to actually have persons that they know taking care of them in the same way that a home health aide might. So you may say, you know, I have a daughter of mine who's really had to take a lot of time off from work to care for me. That daughter could actually be paid to become the aide that would have traditionally come from another agency. So there are some exclusions. You cannot utilize a spouse in that role, And typically you should not be utilizing someone who already lives with you, but rather someone who would be coming into your home. It could be a family friend, a child, a neighbor who is going to assume your care and could be paid and reimbursed to do so. There are a ton of pros and cons. You know, certainly the comfort level is there, and allowing a person to spend time with their family and loved ones is certainly a benefit. However, if your loved one is not available one day, then there is not necessarily a backup plan. While at a home care agency, if one aide is not available, they'll send another aide. So there are some pros and cons that have to be weighed, but consumer-directed care is certainly more popular nowadays.
Thank you so much, Kelly. That was all really helpful to know. And at this point, we're going to introduce Patty Willis, who is a certified reverse mortgage professional with Open Mortgage, who can tell us how a reverse mortgage can help, and mortgages in general would be an option for payment for home care.
Okay, great. Thank you, Laura, and this has been really good information, so thank you. Before we begin, I'm going to tell you a story about a woman I worked with a few years ago. Her situation is a little different than Mrs. Gold's. Mrs. Gorman is a nice woman. She lives alone in her own home, and she has 3 grown children that have given her 7 beautifully wild and messy grandchildren. At 76, she stays as busy as ever between lunches, outings with her group of friends, and volunteer work she does at the local shelter and food bank. Her life is full. She doesn't have extra money, but she gets by. She's doing okay, and all is well until the slightest misstep changed her world. While carrying a bag of mulch into her backyard, Mrs. Gorman trips and falls, breaking both her collarbone and her hip. Even while waiting for the ambulance to arrive, she begins to think, now what? Her children gather around at the hospital, and she can feel their distress as they worry about her and try and figure out what to do and how to pay for it. They're all doing okay, but they all work and have children of their own that are either in college or will be soon. So money's tight. They're worried about mom getting what she needs now, how to pay for it, and how will she ever be able to take care of that house again. Maybe, they say, mom should move in with one of them. But is that really right? And is that what's right for them? And is that what mom wants? So after a few days pass, Mrs. Gorman begins to gain some strength and lets her family know her hopes. She wants her life back. She hurts now, but she's basically healthy, and she feels like she's going to get better. And she knows that one day she may need to move in with her kids, but not now, not yet. So her family sets out to find out what they can do. They discover that short-term Medicare will help with rehab, but then what? So they don't think that mom will be able to take care of the house. They know that she's going to need more help. So they begin their internet research. It isn't until one of Mrs. Gorman's daughters finds the NRMLA website that any real hope begins to appear. Initially, the family was hesitant. Their association with the idea of the reverse mortgage was anything but positive. They've heard things. But at this point, they don't know what else to do. They could either explore the possibility of a reverse mortgage, or they could pack Mrs. Gorman's bags and get her ready for a life that she's not ready to lead. So here's what happened. They did their research. They even talked to a lender or two and decided it looked like a reasonable idea. Mom would get enough money to pay off her current home equity line of credit, and she'd have enough money left over to have a large line of credit for the future. She would still own her home, just like always. She still must pay the taxes and insurance, just like always, but she does not have to make any repayment on the money she's used from that line of credit as long as she's living in the home. So she got out of rehab, went right back to her home. Her family visited when they could. And she had a lot of assistance at first, and then less and less as time went by. She paid for the extra needed care and assistance using her new reverse mortgage line of credit. After a time, she did not need assistance, but still had money available in the HECM line of credit to pay someone to take care of the heavy chores. No more heavy yard work for her. Now she'd only do the gardening that she enjoys. She put safety bars in the bathroom. She did better handrails on the front porch. She even decided she'd get one of those alert buttons to keep with her, to provide her some extra security. A scary fall is enough to make you want a little more security. Next slide. So let's look at some detail. Let's see how this works. So for this discussion, I'm only going to talk about the home equity conversion mortgage. That's the FHA, the government insured program. There are other reverse mortgages, but they all are, but right now they're a small part of the market. I would not disregard the possibility of a non-government reverse mortgage, but there are different rules and it's important to evaluate each option. So right now, since currently 90–95% of reverse mortgages are the home equity conversion mortgage, or HECMs as they're often called, that's what we're going to talk about for this. Next slide, please. So in order to get a reverse mortgage, the borrower must be 62. They have to own a home, and they have to live there. They need to have a fair amount of equity in the home. The amount of money that you can borrow on the reverse mortgage is determined by your age, interest rates, value of the home, and based on that, on a sliding scale, they're going to figure out how much you can borrow. When you're younger, right at 62, you actually have access to less money than someone 95, but that will vary. Credit and income are reviewed, but it's really all about setting the reverse mortgage up to be a long-term solution. You need to be able to pay to continue to live in your home. You still have to be able to afford to take care of yourself and live there. So really it's a matter of looking at credit and income to see if this looks like this is going to work for you. Next slide, please. The home must be in pretty good condition or generally good condition. But it actually is also possible that you can actually use the reverse mortgage proceeds to help do some of those repairs. So if the home has a little deferred maintenance and that kind of thing, something may be required, or even if not required, might want to use the reverse mortgage to get things back up to date. It's available for single-family homes, townhomes, 2 to 4 units. Manufactured homes and condominiums are also allowed, but there's some specific guidelines on those. So you just need to check that out with the lender if you're interested. There's no limit on the value of a home for getting a reverse mortgage. Actually, we do reverse mortgages and do the HECM on homes that are, in the millions of dollars. But the fact is, the money that can be lent on the HECM is based on a top value of $679, $650. So what's going to happen is, even if you're looking at a home that's worth $800,000, when they figure out how much money can be lent, they actually are going to look at that government ceiling, that FHA ceiling on that loan. Next slide, please. So safeguards. First, I just want to say the reverse mortgage has actually been designed and really redesigned, looking for safeguards on this program. There are safeguards all the way through it. Right now, the first thing is that the borrowers must discuss the HECM with a HUD-approved housing counselor. And that right up front, before someone begins the process of a reverse mortgage, they have an opportunity to talk to someone that's not biased, that's been trained, and it gives them another place to ask questions, just to be kind of sure that that everything makes sense and that it makes sense for them. There are specific eligible non-borrowing spouse protections. So one of the things that people would have heard kind of in that, oh, I've heard things about reverse mortgages, is that it can be a problem for spouses. Well, there are now rules that help protect and allow a spouse, even if they are younger than 62, they can allow that eligible spouse that's not part of the reverse mortgage the opportunity to stay in the home and not have to repay the reverse mortgage. So again, it's just been kind of designed as things have occurred in the program. They've redesigned things so that there are protections there. There are restrictions on full draw cash advances. This is kind of the loan protecting us from ourselves a bit. But what it means is on the HECM, you cannot say, okay, I can borrow this much money, just give me that whole stack of money and, I'm going to go on about my way. There are actually some restrictions on how much money you can obtain the first year of the program. You can then, kind of tap into the rest after that first year. But what it does is it's just kind of to, again, getting people in the thought that this is a long-term solution, not a quick fix if you just need a lot of money to do something right up front quickly. It is designed to be a long-term solution for someone. Now, that full draw cash advance does not apply if you're paying off a mortgage. So if you have a mortgage on the home and you need to take all the funds from the reverse to pay off an existing mortgage, you actually can do that. But you just can't take that out cash. So again, there are safeguards all through the program, every step of the way, and it is designed as a long-term solution to help people be able to stay in their home. Next slide, please. So one of the things with reverse mortgages is kind of what's different about reverse mortgages from anything else. And first, the available funds on a reverse mortgage can be set up as either a line of credit, a monthly cash advance for the life of the loan. It's called tenure, which is hard to say because it sounds like 10 years when you say it over the phone. A monthly cash advance for a specific number of months, or a combination of the line of credit and a monthly cash advance. So with that, one of the things is with that line of credit, the unused portion of the line of credit grows. So it creates a larger line of credit to draw from over time. So it again, as part of this long-term solution, you can leave money in that line of credit. You know that it's going to be there, and you can tap into it, and it will actually even be larger. Kind of like if you had a credit card and every year they said, okay, now we're going to just increase your credit line. You haven't used this, so you know what, this year you can take this amount of money instead. And they increase that over time so that you have an opportunity to tap into it. And that can be a huge piece of security for people in the long term. The line of credit cannot be reduced or frozen because of a change in the home value or income or credit. One of the things that happens with HELOCs, or the home equity line of credits, that most people have, not in the reverse mortgage, not the reverse mortgage line of credit, is that there is, I would say, almost always, but generally there is a clause that if the home value drops, that line of credit can just be withdrawn from the bank. If the bank at their wish, with any kind of changing factors, can stop the line of credit. So if you're counting on that going into the future as your emergency pool, you don't know what might happen, and it can be withdrawn. And back in 2008, 2009, 2010, maybe into 2011, a lot of people's home equity line of credits were stopped. And, they didn't necessarily say, okay, now all the money has to be paid back, but they would say you can't borrow anymore. So, as far as kind of counting on that as your cushion can be kind of difficult. And, again, unique feature of a reverse mortgage is there's no monthly payment required. So you don't have any regular monthly mortgage payment that you need to make. Now, it's still your home, so you do need to keep paying all your general homeowner expenses, the taxes, insurance, homeowner association dues, and just your general maintenance, utilities, everything else. It's still your home. It's just a home with a mortgage and with a unique mortgage on that home. But you do not need to pay anything to the lender with the reverse mortgage. Also on the reverse mortgage, which a lot of people don't really even think about, is a prepayment can be made at any time and with no penalty. So with the HECM, if you have a line of credit, and I'm not really getting into some of this because you could set up a HECM without a line of credit, but with these features, if you set it up and you have a line of credit, you can actually make payments on that mortgage, pay down your balance, but you are paying back a line of credit, which means you'd be able to re-borrow that money if you needed to. So you really do have kind of full control of your own destiny. So if you're in a situation where you maybe can make payments now, but you want to have the security, you could go ahead and get a reverse mortgage, make payments, and then stop at some point in the future, and then even draw on the line of credit on those payments that you would have been putting into it if you need to do that. Also, the HECM is non-recourse. What that means is if you've borrowed the money on the line of credit or on the reverse mortgage and you have not made payments on it and your loan balance is just growing and you live in the house sometime or maybe home values go down and you end up in a circumstance where the loan balance on the reverse mortgage on that HECM is more than the value of your home. First, it doesn't impact anything that's going on with your loan right then. If you have money that is available to you to take, it is still available. But what it does do is it means if you then needed to move or if you passed away and your heirs inherit your house, no one is responsible for any debt beyond the value of the home. So there's not a concern of heirs where that loan balance gets so large and they think that's going to come from some other part of the estate, or from your life insurance or from, your other assets that you may have. The only thing that needs to be used to pay back that HECM is going to be the home. And generally, there's actually equity that would be going to heirs, but if not, they have protection. Okay, next slide, please. So now we kind of went through some of the details, a little bit about how it works, but I'd like to get back to Mrs. Gorman and her story. So when I met with her, that was 2 years ago. Now, she's a nice lady. She's living in her own home. She's now 78. She's active. She has friends. She still volunteers, not quite as much as she used to. And she still has her family to her home for the holidays. So this family had a choice, and they made the most of it. Sometimes it's too hard to do this when the situation calls for quick action. And that's why I recommend that everyone over 62 looks at this option. And when it's feasible, put a reverse mortgage, put a HECM in place before it's needed so that it's there, it's available. Then there's not a financial emergency. Because for most families, there will be an emergency at some point. And the only family distress should be about how to get mom or dad better and not how to afford it. Now, there are lots of stories and reasons to do a reverse mortgage, and I cannot provide all the reasons. It is a very flexible tool designed for people in retirement. And the way it works and the benefits it provides are as unique as the life of the borrower. And that's it. Thank you.
Thank you, Patty. I have a few questions for you. What would happen if there was already a reverse mortgage or an existing mortgage on the house?
Okay. Well, if there's any existing mortgage on the home, it would need to be paid off. Usually that would be with the proceeds from the new reverse mortgage. It is possible if they even have an existing reverse mortgage that they can refinance with another reverse mortgage and get more money. That is possible. That usually calls for home values to have gone up in a specific area. But you know, if home values have gone up, and that's possible. But generally, I mean, I would say actually most people I work with actually do have some mortgage on their home. Some, you know, bigger or larger. Like Mrs. Gorman had just the home equity line of credit on her house. Most people have kind of something. And, you know, we just pay that off, and then the rest of the proceeds are, you know, used however it's chosen that they're going to be used.
Thank you. That's really good information. And is there a time that a reverse mortgage would be the wrong solution? Is there something that would make that be maybe they should look elsewhere?
Right. Well, I mean, I'd say a couple of things. You know, first, there are times when adult children live with the senior homeowner. And there's a family understanding that the adult child will keep the home when the senior passes. A reverse mortgage, you know, by its very nature, reduces future home equity. And, you know, I mean, that's so that the senior homeowner doesn't have to make payments toward that loan. And a reverse mortgage becomes due when the senior homeowner passes. So if there are heirs that live in the home and plan to continue to stay in the home, you know, they would need information. They need to understand the reverse mortgage. And frankly, they need a plan. And otherwise, you know, the reverse mortgage, that may not be the answer for them. You know, they may want to look in some other direction. I'd also say, so, you know, as I kind of mentioned, the reverse mortgage is designed to provide a long-term solution for the homeowner. You know, and that's kind of optimal when someone can set this up and, you know, they've got enough money in it and they've got their income set up and they know that they are then comfortable with a little cushion. But what if it only provides enough money to help for a while? Well, that depends. You know, it's kind of like, well, then what? You know, it may be that if it just doesn't provide enough money to help someone be able to stay in that home, then it may be that it is not going to be the solution. And, you know, that homeowner would be better off selling the house or, you know, doing something else to make that work. On the other hand, you know, people will often say that you should only get a reverse mortgage if you plan to stay in the home for long term. And although that's generally the case, if someone needs money for in-home care and the reverse mortgage can only provide enough money to keep them in their home for a few more years, you know, with the assistance that they need, you know, as long as the cost of the reverse mortgage are found to be acceptable to make that work, well, it may be worth it to them. You know, they may look at that and say, yeah, this is, you know, if I can manage to stay in this house for a few more years, you know, even though it will only let me stay here for a few more years, that's worth it. It's a matter of just kind of understanding the cost of the reverse mortgage, how the money lasts, how long it's going to last. And again, I'd say kind of having a plan, you know, so then what? But, you know, those would be, you know, when I would say, you know, it doesn't work. Again, it's mostly looking at the long term, but other options can work sometimes too.
Well, Patty, this is Jenny again. I want to thank you and Laura and Kelly for your incredible presentations today. I did want to see if we could get in a question from one of our participants who asks about reverse mortgage borrowers and if they pass away and the property is upside down, Does the lender just take the property so the heirs don't have the expense of selling the property? What happens in that situation?
Well, the heirs can sell the house, and actually, they actually can sell it for even 95% of its value. The lender, the heirs are not responsible for anything. So if the heirs don't want to do anything, they do not need to. They could talk to the lender and not proceed. They're not responsible for any loss. A lot of time the heirs are looking at a family home, and they want to sell it. And then really it's a matter of working with the lender, because the lender will accept and work with them in going ahead and selling that house. But the heirs do not need to take a loss on that house.
And do they have an option of just saying they don't want to deal with selling it and they don't want to manage it, and they could just say?
They can. Absolutely. They can just sign. They can actually just sign it over if they've inherited. They don't just, give it to the lender. They are not, that is not going to be any, they have no obligation on that mortgage. And the lender would just take the house, and then the lender would sell it and do what they do. So the heirs do not have any responsibility.
Well, thank you for answering that. And just one more question for you, Patty, regarding non-borrowing spouses. So if the borrower dies and the non-borrowing spouse is staying in the property, does that non-borrowing spouse still have access to the line of credit?
They do not, because the non-borrowing spouse is actually not a borrower, so they can't take any of the money. So if there is money available, any money available would no longer be available. But they can stay in the house. So what they've done is they've waived the loan being due, so that the loan does not have to be paid back, and that person can stay in the house as long as they live. They just need to, meet the same requirements as far as paying taxes, their real estate taxes and that kind of thing.
Well, thank you for that answer. And for more information, here's another question that just came in. How does the lender know when the borrower has passed away? How do they find out?
Well, so we ask that you notify the lender. And if you want to keep the house, sell a house, do anything, it is really important to communicate with the lender and with that servicer as far as just, what you want to do. So I would, absolutely encourage people to do that. That's going to be the best way to protect any equity in the property, and is just to contact that servicer right away and work with them. But servicers have, they're all part of different lists where they get reports, death notices from government. So they know, they get their own records. So if they are not notified, they will find out. In addition, people are sent a letter yearly from the servicer, just kind of saying, do you still live in the home?
And how many
but
months?
That's more about occupancy. Pardon?
Right. And then in terms of, like you were saying on occupancy, is there a rule on the number of months that they have to be there to be considered owner-occupied?
It has to be your primary residence. I mean, that's generally considered, over 6 months of the year. But, it needs to be your primary residence. So you can have a second home, and you can travel and go to your second home. But it does need to be your primary residence. In addition, if someone's out of the home because maybe someone is sick, maybe they have to go into a nursing home, you do have time. You can be out of the house for up to 12 months if it is because of any health reason, mental or physical. So, you have time. The design, again, the design of the reverse would be to give you time that if it was feasible that someone was going to come back to the house, that the house would still be there. And I think, the rule is basically set up thinking that if someone's out of the house for a year, they're probably not going to be able to come back to the house, and then something needs to be done.
Right. And I know that when we were preparing for our presentation today, we were talking about how loan proceeds from a reverse mortgage could potentially impact eligibility for other programs that we talked about today. So we heard a lot from Kelly about different ways to manage funds and to work with Medicaid programs, and are reverse mortgage loan proceeds factored into those equations, Kelly?
So with Medicaid, we were talking a little bit about income, and Medicaid looks at the income that you're receiving on a monthly basis to determine eligibility. And that could come from, as I said, Social Security, pension. There are certain things that are protected, such as 401k or like mandatory IRA payments. So it depends on how you've set up your reverse mortgage and whether or not you're actually receiving monthly income.
Thank you. That is very helpful, I think, for a lot of people who are listening today. We've actually come to the end of our presentation time, so I want to thank all of our participants. I want to definitely thank our presenters. I want to remind people that if you do have more questions about reverse mortgages, you can visit NRMLA's consumer education website, reversemortgage.org. You can find lenders on the site who are all members of our association and follow our strict code of ethics and professional responsibility. I also want to let folks know that we have some handouts associated with this presentation today that you can see in the GoToWebinar toolbar. We'll also have a recording available later on reversemortgage.org. And on the website, you can also find information about considerations to think about if you're looking into a reverse mortgage, some questions to ask yourself. We also have a copy of the slides up in our handouts, and that will be posted to the website. And then if you or your loved ones are really considering, are you in the right home? Is this the best place for you to be as you get older? We have some resources about that as well. So again, thank you all very much, and I hope you have a wonderful afternoon.